good afternoon to everybody. What I would propose to do is really to continue to set the scene of what we think the challenges are as investors that you still face. For some of you who I know were in the room a year ago, these challenges actually haven't changed, and therefore I think the challenge that we have remains much the same as I described last year. I would like just to talk about a couple of investment themes that I think are interesting that you should be looking at in your portfolios and thinking about in your portfolios. And finally, obviously, to give you our perspective on what is going on in Europe, particularly around the politics, and finally to finish with some conclusions and obviously to answer any other questions that you may have. So just to set the scene, the world is still, as far as we are concerned, in a period of financial repression. Growth remains low, inflation remains low, and interest rates are going to remain low. So for many of your clients who are looking for an income or looking for a return, they are going to remain frustrated by the increasing volatility they see in financial markets and the difficulty with which we are all finding it to earn the return that our clients are looking for. This world, even here in China, we have solved the debt crisis of 2008 and 9 with more debt. The world is now carrying over $200 trillion worth of debt, and that debt is a big rucksack on our back. It is slowing the ability of the world to grow. So the way I want you to think about financial repression is that we can either be a German and save and pay off this debt legitimately. We can be a Greek or potentially a Venezuelan any day and default on our debt. Or we can be an American or a Brit and we default through inflation. So I think when you think about what the Bank of Japan is trying to achieve, what the ECB is trying to achieve, what the Federal Reserve is trying to achieve, is they are trying to achieve a level of a level of inflation of 3 or 4%. Interest rates will remain deliberately low, and 10 years later, the real value of that debt will have been inflated away by about 50%. So this is a long-term game. We don't want 1 year of 50% inflation. We want a sustained period of stealth inflation. So I think for you, in trying to protect the purchasing power of your clients' wealth, you have to understand that that is the game and that the central bankers will remain behind the curve, lower for longer, very unkeen to respond to any imminent signs of inflation. This is the challenge that certainly Japan, Europe, and the US face, and we think this is the solution. The default solution, the Greek solution, is clearly very painful to the financial system and to everyone who has lent money into the system. So in a world of lower growth, we also have the challenge that China is rebalancing. So even the growth of the last 10 years is going to look different in the next 10 years because China's growth model is going to change. And therefore for China itself, but also for all the Asian countries who have relied on China's growth, they not only have to adopt their business model to the new Chinese growth, but so does every company who wishes to be successful in China. And the other thing, of course, is that as China's business model changes, its requirement for commodities is going to change. Although there is still obviously a lot of infrastructure and a lot of residential building going on in China, the need for copper and iron ore is beginning to change. Whereas the need for energy and oil remains pretty resilient, given that even when I was in Chengdu last week on holiday, I was told that Chengdu is selling 10,000 cars a week. So the underlying demand for oil in the Chinese economy is going to remain pretty resilient. So other things that have happened so far this year is fears around the renminbi. Now, we believe that a sharp devaluation in the renminbi, whilst it will be good for the manufacturing sector of the Chinese economy, would not promote its rebalancing and it would not encourage greater globalization of trade. So we think the fears are massively overdone, and therefore we think that the renminbi will remain relatively strong compared to many of the other currencies. So we think that's one concern that the markets shouldn't worry about. But one thing that we have seen this year is the clear divergence of monetary policy. The US is trying to raise rates. And our analysis, or our analysts in New York, are absolutely certain that the Fed will raise rates if they can. Clearly, they are data dependent on the US economy in particular, but they will increasingly be data dependent on the US election. We believe there's a strong chance that they will raise rates in June because they don't want to raise rates in September ahead of the election in November. So the political cycle, we believe, will interfere with the US interest rate cycle, particularly if the economy, after the strong retail sales numbers last week, continues to now maybe start to recover through the summer. So politics around the world is going to continue to play a part in what is now a volatile set of asset classes. Currencies will remain volatile, equities are going to remain volatile, and so are the bond markets. They are all now interlinked, and one change of political policy in one country can rapidly turn around and affect interest rates or currency rates around the world. So we think in this environment, you have to accept that the markets are volatile. We have to accept that the quantitative easing is essentially over in the US, which is the key market, and therefore the rising tide of asset class prices has essentially finished. The negative interest rates in Japan and Europe have created uncertainty for many investors, but what they have done is they've driven most of the bond markets in those markets to negative yields, so there is no prospective return in those markets now for investors. You have to be clear and confident of the strategies you invest in so that your clients understand how you are going to generate the returns. And we think you have to remain thorough and diligent about updating yourself with the investment processes and your analysis of the market. So this is an active market. We believe buying cheap index products will no longer generate return for your clients' portfolios. They will only generate volatility for them. So just to pick up on a few themes. This chart, if I briefly explain it, shows you what the Federal Reserve say every time they meet. What they're saying here at the bottom is in the long run, their policy will work and that they will get interest rates to around 3.5% to 4%. You would expect policymakers to tell you that in the long run, what they are doing will work. But as each meeting has taken place, what you can see is their expectations of when they can raise rates have fallen. This is what financial repression looks like. As growth slips through their fingers, as inflation remains low, their ability to raise rates slips. And so we think this will continue to happen in the US, in Europe, and Japan, because growth will continue to disappoint, and therefore their ability to raise rates will disappoint. The nice thing about falling medium-term interest rates is they therefore make equities look supported from a valuation perspective. And therefore we think you are being paid to take the risk during this period because equities will do okay in a falling or non-interest rate rising environment. However, policy is going to remain very difficult from a monetary perspective because you effectively have two barbells at work. You have the US and the UK who look like they want to raise rates as their economies start to improve or at least look okay. And at the bottom end, you have the disinflation fighters of Europe and Japan. And in between, you have loads of other countries that you may be investing internationally who will be buffeted differently by their connection to either the yen and the euro or to the dollar. So clearly, a lot of the emerging markets, like Hong Kong, South Africa, Turkey, they are pegged to the dollar. Therefore, whatever happens to the dollar in terms of monetary policy or strength or weakness is something they just have to accept. They have no control over where their currencies or where potentially their economies may move. Whereas in Denmark, Sweden, and Switzerland, they are pegged effectively to the euro, and they even have even more negative interest rates than those imposed by the ECB because they're trying to keep capital out of their economies. As the ECB cut rates, they were worried they would be overwhelmed by money leaving the euro to go into the Swiss franc, for example, which is why the peg was broken last January. And then you have the countries in the middle who are basically victims of the moves of either the yen and the euro or the dollar. China being a classic example. if the yen and the euro are very weak, you start to lose global export market share to some of your main trade competitors. If the yen and the euro are stronger, suddenly China has more say in the game. But you will find each of these countries is buffeted by what is going on. So when you're looking at your international investments, you have to look at them through the lens of what are the key areas of monetary policy from other areas of the world that can affect your perception of how those currencies are going to trade. And so therefore we think this will continue. And I think it has been made worse for all of us. And I know many people in the room will be feeling uncertain. There are many people at Allianz and Global Investors who are uncertain because policy is being made dynamically. How the economies perform will change policy. We are in a very dynamic, data-dependent market, which is making a lot of clients short-term, it's making us short-term, and therefore it's making us much more vulnerable to the short moves in the marketplace, when in fact what we should be trying to do is remembering that we're in this for the next 5 or 10 years and looking as long-term as we can whilst managing the volatility that we see on a daily basis. Now, I would like to talk briefly about the renminbi. I mentioned it in my opening comments, but this chart shows from January 11 to through to 2015 that China has been a good global citizen. The difficulties in Europe, the difficulties in Japan have basically been tolerated by China because China has allowed, with the US dollar, to strengthen. But it became very clear during 2015 that the Chinese were beginning to lose export market share around the world, which was putting their manufacturing sector under pressure, both from a profitability perspective and from an employment perspective. So we believe what happened was the Chinese increasingly, during 2015, decided to stop the appreciation of the renminbi. And how did they do this? Well, we had the shock announcement in August. I call it a shock because although the headlines were huge, the devaluation was less than 3%. When the Kazakh tenge had a devaluation, it fell 37% on the first day. That feels like a proper devaluation. So although there's been a lot of headlines about the Chinese devaluation, our analysis is that it is not in China's interests to devalue because the rebalancing of the economy means that the spending power needs to go to you, the consumer. And therefore, a strong currency allows you to buy more from the rest of the world than a weak currency does. And if China is true to its rebalancing objective, it needs to rebalance away from exports and manufacturing towards services and consumption. So we think it's not in their interests to devalue. And what they've done is they've basically said, we don't want to peg the dollar. That was the announcement in August. Then in October, we had the creation of the basket of currencies, which then allows China and the renminbi to settle against all its industry, all its international peers, rather than just the US dollar. And we therefore think that this is a credible part of the internationalization of the renminbi. It's now a much more stable currency. It's not as pegged to the dollar. It means that it represents China more rather than it represents a peg to the US dollar. So we think this is a rational part of the process of creating a China asset class which has equities, fixed income, and the currency as independent international tools. And obviously, in November, we saw the admission into the IMF's strategic drawing rights. We think this is a positive sign for the credibility in the longer term of the renminbi. And certainly you would expect to see the central banks and the sovereign wealth funds around the world now invest somewhere between 500 and 700 billion US dollars in the next 3 to 5 years. If they are expecting this international credibility, it again makes no sense to then have a 20% devaluation of the currency in the next coming weeks or months. So we think this is part of a process, but the key is that the renminbi will not be devalued sharply, but it will be used as a tool to help rebalance the Chinese economy in the coming weeks and months. Now, the other thing that has buffeted the markets this year has been oil. I find it very odd after nearly 30 years of investing that rising oil is suddenly good for equity markets, because what we know as an economy is rising oil is a tax on consumption, and therefore in theory rising oil is bad for equity markets. But the markets at the moment have decided that rising oil is good for equity markets because the energy sector goes up on the basis of this. So we have to run with whatever we're given. But we think there's a better story. One of the things I think even a year ago that I would have said to you was we were perplexed that falling oil had not been met by rising demand. Normally oil is quite price elastic, and therefore a lower price has more demand, a higher price has less demand. But what we are finally seeing globally is that the low oil price is now seeing more people using more oil. And interestingly, in April, on a marginal basis, India is now buying more oil than China. So that's quite an interesting dynamic in terms of where demand for oil may come from in the future. So we think there's rising demand. We know that there's now falling supply in the United States. So supply in America is going to start falling off with the oil price at this level. And we are also certain that the Saudi Arabians and the Russians are producing as much oil as they can. And very soon, they are going to have to move into a maintenance program and cut their production simply to keep the fields working. It's just good engineering policy. So we think at some point, the Saudis and the Russians will start to produce less oil, which is interesting because we think by the end of this year, there will not be a supply glut, as you read about in the news. We think there will be a deficit so that the excess stock will start to be eroded very rapidly this year and into next year. On the basis of this, I would, and we are recommending that you think about stress testing your portfolios for $50, $60, $70 oil rather than $40 or $30 oil. Because oil is a unique commodity, very, very different to iron ore and copper, for the very simple reason that at the moment, the world consumes 95 million barrels of oil a day, but in a year's time, 6 or 7 million barrels of that oil will not exist because they have been depleted. And at $45 a barrel, it is not sufficient for the world's oil industry, including China's, to invest to make an economic return. So the world will need the oil. Our ships, our cars, and our planes still require oil. And therefore, we will need $65 to $75 oil to get the oil industry reinvesting to meet that supply depletion. We don't want $120 oil because we go back to the problems we had in the past. But I think the key is to think about this in terms of when you look at your portfolios, what if I get $50 or $60, $70 oil in the next 6 months? There will be losers in your portfolio who have benefited from the low oil price in the last 2 years. I think the story in oil has one other interesting angle. If you're looking for returns in these markets globally, if you take very little risk, you now earn very little return. But one clear risk out there is the wars in the Middle East. And with the resilience that ISIS is showing, with the confrontation between Saudi Arabia, Syria, and Iran ongoing, I think you have to assume at some point that there could be an event in the Middle East. We may not look for it or hope for it, but it may happen. Whether you think it's a 5% chance or a 10% chance or a 20% chance is up to you. But the key for me with this is, therefore, waking up tomorrow morning to find oil at 120 because someone has shot a Saudi tanker is a high likelihood, in which case that would have recessionary implications for many markets. It would have big industry implications for many industries. If you think about what's happened here in India and in China, you've taken the subsidies off oil. So if oil goes higher, you could expect to see more money spent on oil consumption and less on actual consumption, as in the US. So the world has different parameters looking forwards with oil than we had going in the past. Now, as many of you will know, the energy sector is a popular high-yielding sector, particularly in Europe. If oil goes up, its earnings go up. If the oil price spikes because of an event, it will go up when the rest of the market goes down. So I think you can find ways to help manage inside your portfolio some of these tail risks that are clearly out there from the world economy. And lastly, although this is a very busy chart, I just want to focus on the 2 columns on the left because this is something that I think is coming to China very quickly. I was asked by another investment consultant to talk about a theme that had no product, no market, and no economic consequences. So I actually wondered why they'd invited me to make a presentation. But in the end, I settled on longevity. And what this chart shows, and I'm fairly confident your data would be the same now, my mother was born in 1932, and when she was born, her expected life expectancy was 63. Courtesy of good healthcare, good diet, and all the things that we all now benefit from around the world, she's 84. So it's lucky that she saved for a pension. I was born in 1962, and when I was born, my life expectancy was 70. My life expectancy today is now into my 90s. Why do I say this? Because your clients are also going to be benefiting from living longer. But as the guardians of their wealth, what you have to consider is for every 10 years that they live longer, they need a third more money on the day they retire. Now, on the basis they don't have that money, we as an industry are going to have to earn them that money. So again, when you think about, even here in China, the costs of healthcare, they're rising. Their expectations for their lifestyle, generally property prices and living in a city like Shanghai are rising far faster than the CPI is rising. Their underlying inflation rate might actually be 7 or 8% a year, not the 2 or 3 of the government CPI statistics. So when they've retired, if you don't keep accruing capital into their wealth, they won't have the money when they retire. The only way to have this conversation with them otherwise is to come and ask your clients the day they intend to die. Because on that basis, you can do a DCF backwards and work out how much you need to earn for them. Now, given that that's a tricky conversation, I think one has to therefore think about helping clients understand that the more they want to live longer, the more they want to live healthier, the more they want to enjoy themselves in their retirement, the more they may have to have more risk in their portfolios than they would have expected when they were retiring to start with. So I just think in the back of your mind, longevity is something that I think we have to think about very carefully from our clients' perspectives. So just to a couple of investment themes. What I do every year is I talk to all my investors around the world about their best ideas. And I sort of collate them together into various themes. But the two that I wanted to spend a minute on, and I've spoken about one of them already, the two big themes that my investors were focused on this year was China's rebalancing and the impact that it would have on many economies and many commodities, but also on disruption. So I thought I would talk to you today about disruption, because I think what we are seeing is many industries around the world now being positively disrupted. Here in China, we all know the success of Tencent and Baidu and Alibaba, and it's all predicated on the mobile phone and the internet. This is the same in the West, but it is now happening at an unprecedented rate. And so many companies who are not anticipating this disruption are going to end up losing from it. So I think from a defensive perspective, you want to have your money with fund managers who are anticipating how this disruption is changing the industries and are capable of analyzing the winners and the losers. It may be hard to benefit from the winners, but you can certainly avoid the losers inside your portfolios. But there's another thing, and I know this is true in China as well. There's another disruptor out there. Some of them are in the room. They're called the millennials, born after 1985. The millennials are very different customers from their parents. I know, I have 4 millennials, and they don't go shopping. If it's not online, they don't, or it's not on their phone, they don't buy it. It's great. If I say to my daughters I'm going to treat them to a dress or a present, they go online, they tell me what they'd like to buy, and 24 hours later it gets delivered. I don't, like with my wife, if I say I'm going to buy my wife a dress, I spend all day walking around London. I mean, it's exhausting. So for businesses, my point is businesses are now going to need 2 business models. They're going to have the millennial business model, who are the future consumers in every economy around the world, and they're going to need the old business model for people like me who don't want to do everything on their phone or on the internet. That is another opportunity for disruption. But I think when one thinks 5, 10 years out, there's another interesting disruption coming, and maybe even here in Shanghai you would welcome this. If you think about the recent investment by Apple in Didi and Uber and all these type of things, having a taxi on your phone is a very, very useful service. But if you then think about the fact that we will have maybe in 5 to 10 years' time cars that can drive themselves, you can blend the two services. So that when you need a car, you use your DD web app to call for it, it arrives, you get in and you tell it where it needs to drive you. You don't need a driver anymore because you'll have a self-driving car. And what is interesting for all of you who have the iPhone 6 in your pocket, that phone has enough computing power in it today to drive your car. All it needs is the car and the app, and it can do the rest. So we're not far away from having another very interesting disruptor. Now, what's interesting about this is if you think about your own driving, you probably use your car 10% of the time. So a lot of the time, it's parked in a garage, either at home or at work, or at a football stadium or wherever else you go, but it's wasting time. It's just sitting there doing nothing. So a lot of economists have studied the optimal use of cars and have said that if everyone just used a car when they needed one, and obviously that does imply that you could have car sharing, you would actually only need 10% of the cars we have today. If you only have 10% of the cars today, suddenly Shanghai traffic would look a breeze, and you would use a car when you needed one, and the rest of the time you wouldn't need a car. So it optimizes global resources, but it is very disruptive. At the moment, China is buying 18 million cars a year, but it might only need 1.8. Huge ramifications for the car companies, the suppliers, and the industry. But at least the infrastructure is already built. So the roads would free up because you would only have 10 or 15% of the number of cars out there over a period of time. Now, Allianz is very engaged in this because Allianz insures 50 million cars around the world. And there's a presumption now that if you have a self-driving car, you don't need car insurance. So Allianz is worried about losing 50 million customers. So if you play this scenario across many different industries, you find the losers are not just the people who you think about first. There are other consequences that would come through. If you like driving, the future is going to be your car will drive you to a racetrack, and then you'll be allowed to turn off the computer and drive your car. But the moment you come back into the system, you are not allowed to drive. Human beings crash. Computers won't crash. So there are loads of interesting things that are going to come through. And I know for my children, please all check with you and your friends, but 2 of my children don't drive, not interested in driving in the slightest. In my generation, everybody drove because it was the only way you had freedom. And so I think as the technology changes, as the use of Uber and Didi and similar things become more pervasive, customer behavior, consumer behavior will change very, very rapidly. If you think about it as investors, if my children don't go to malls, then maybe there's some commercial real estate trouble ahead because people won't go shopping in the malls. If they don't go to the malls, they don't need the car parks. The office blocks don't need the car parks. So there's going to be a lot of opportunity, but also a lot of risk to commercial real estate because in 20 or 30 years' time, a lot of properties are full of car parks. They're not going to be earning anything with this anymore because you won't have the cars. So do play with it when you're sort of wandering around just thinking about the future, because some of this disruption will happen very quickly, and some of it will happen because of consumer choice, not because of regulation and anything else. And the last thing I would say is we are also going to see disruption in the financial markets. Although I have the book, so I'll recommend it to you at the end, but although you think about things like Bitcoin, the underlying interesting disruptor is the blockchain technology. Blockchain technology would actually mean that you no longer need a bank because it would guarantee that I have the money and I'm paying it to you, and that the technology would guarantee in payment. So there's a lot of interesting things, even in our own industry, buying and selling shares, where new technologies could change existing architectures and existing structures in a way that we have yet to anticipate. But there's another change coming, and this is a regulatory change. But we think climate change is very, very interesting. And I know, having had my week off in Chengdu last week, that the Chinese are very sensitive to climate change. You're now very sensitive to the quality of your air. Now, we know that in the next 5-year plan, the Chinese government is going to spend $500 billion on improving the environment in China. Some of that we will be able to make money from. But what you're seeing is on the red-hand side, you're seeing high carbon industries are now under pressure around the world. And as investors, what we clearly want to do is make sure that we are as smallly exposed to those industries as possible, because the future is not with them. They could end up with stranded assets and with significant losses, whereas the future is going to be in the low carbon, the greener areas, where investment is going to go in, solutions are going to be sought for the higher carbon economies. So even in China, I think the sensitivity around the quality of air is going to drive significant policy change from the government, and it's going to create investment opportunities for everybody here and around the world. So we think this is also very disruptive, and it will add to the sense of business models under pressure and the need to change and the need to understand how the world is changing from a corporate perspective. How we have done that is we have now put our environmental, social, and governance research into all the stocks we follow, so that we make sure when we're making investments that we understand the environmental impacts, and we've talked to the managements about those environmental impacts. We've looked at the fact that we want to make sure on your behalf that we're not using child labor in Bangladesh or in some places in Africa or whatever, but also we want to make sure that the governance remains correct. One of the exciting stories here in China is obviously the potential inclusion of the A-shares and then even the LSE joining with the Shanghai in a sort of connect arrangement. But one of the consequences of that is that things like governance are going to have to get better. The transparency is going to have to get better. And that will, I think, increasingly aid the integration of China as a standalone economy into the world's financial markets, which I think is where you all want to be in the next 10 to 20 years. So just to say something about Europe, and to take the ugly question first, the politics. Politics is going to remain an issue in Europe for the foreseeable future. Before I talk about Brexit, let me talk about the politics. In December last year, we had a Spanish election. There was no government formed, and they are going to the polls 2 days after the British referendum. So for the last 6 months, Spain has performed really well. The economy is doing fine, but it has not had a government. Interesting model, of course. The Irish, again, had the same challenge, and they have yet to form a government. In September, we will have an Italian referendum on reforming the Italian constitution, which is the first major piece of legislation from Mario Renzi, the Prime Minister. And in 2017, we have the French presidential election, and we have a German election. So Europe is not going to leave the political headlines. But how I would help you from a European perspective with this is that the headlines will create some volatility. Yes, they may even create some uncertainty. But underneath it, the European economy is growing at 2%. It's growing more stably and more strongly at the moment than the US is. Unemployment is falling. Fiscal stimulus is there from some of the governments, and we're seeing investment and consumption. So Europe is doing okay. It's not a China, never will be, but 2 to 2.5% economic growth is absolutely fine for Europe at this moment in time. But the headlines will make you concerned about Europe. But you don't really need to be, because underneath the headlines in Europe, you have the power of the ECB and the quantitative easing, which is taking away the economic risk and the tail risk from the markets. So if you see more economic concern or more political concern in Europe, you would expect to see the euro weaken, which will be good for the competitiveness and the profits of Eurozone companies. So I would urge you to look through many of the headlines, because they're going to be here for some time to come. The difference, I would argue, is Europe has had political uncertainty since 2010 and 11 with the Greek and the Italian crises. We're about to get political uncertainty in the US. The Trump nomination is an interesting one, even from an American perspective. The Americans can't believe that they are about to vote for Clinton or Trump. So So I think the dynamic there is that American assets are going to become more volatile because of the politics, in the way that European assets have been more volatile. And I think even in China, if you think about the last 12 months, the change of regimes, the new 5-year plan have created volatility in Chinese assets and in the Chinese economy. We've seen that same volatility with Prime Minister Abe in Japan. You and your clients are going to have to live with a certain amount of political volatility. The key is whether the financial system and the monetary policy is going to enable you to inoculate your portfolios from the underlying volatility of the politics. So we would argue that in Europe, we've lived with this uncertainty for some time. Valuations look attractive in the equity market, and therefore we think the volatility is one where you would look to add to weakness rather than be worried and buffeted by it. So to the big issue at the moment, Brexit. At the moment, the bookmakers in the UK forecast that the UK will stay in 70%, which feels a comfortable majority. So the money is saying the UK is staying in. Currently, the polls are saying it's 50-50, so it feels quite close. And therefore, lots of international observers are feeling very worried about that. Now, what I would say about that is, in speaking as a Brit, 1/3 of the population want to leave, and they are passionate about leaving. They're not worried about the migrants, they're not worried about the economics, they are leaving on principle. They would like to be Britain, not part of Europe. So there's almost nothing you can do to argue that. You either believe in Little England or you believe in Europe, but that can be a sort of, you can't debate one to the other. I'd argue it's a bit like Taiwan and China. At the moment, there are two views. 1/3 are staying. They're less passionate, but they like Europe, they're very comfortable inside Europe and feel that the world is becoming a bigger place and therefore the UK should stay inside Europe. So the piece to worry about is the third in the middle, who have yet to make up their mind. And I think this is where the migrant issue is very interesting, because the people in the UK who are worried about migration are not worried about Syrian refugees. They are worried about Romanians and Hungarians and now potentially Turks coming to the UK and taking their jobs. And that is the migration that the UK doesn't like. Accepting some war-torn stragglers is definitely a different type of migration. So I think one of the things I would say to you is that at this moment in time, one of the things I fear, although I hope it won't happen, is another attack in Paris or Brussels or somewhere in Europe. Because an emotional vote would be a terrorist attack means I would be better off as Little England rather than as part of Europe. But I think if we avoid a terrorist attack of some type of nature, what we will end up is finding that Europe will, the bookmakers will be right and there's more people who want to stay. How do you navigate that in the short term? You watch the level of sterling. If sterling's going down, you know people are worried about us staying in Europe. If sterling is stable or rising, as it has been for the last 2 weeks, you can say that maybe people are now more relaxed. But it will be close. And so therefore that's slightly unsatisfactory. Now I have worked, as many of you will know, in Frankfurt for 14 years, and I'll give you one other piece of color. Europe gave Britain lots of reasons not to leave. They didn't give us a reason to stay. And I think that's a disappointing conclusion in the end, because the Italians, the Greeks, the Germans, the French, they all need to know where Europe is headed. So whether Britain stays or whether Britain leaves, what you should expect is to see the journey to the United States of Europe quicken after this referendum. The ECB has done a good job of putting the foundation blocks in place for the monetary union of Europe behind the scenes, but the politicians have yet to put in place the fiscal blocks to get to the United States of Europe. And I'd give you an interesting example which I learned when I was in Chengdu on holiday last week. When Sichuan was hit by the earthquake, it clearly devastated a lot of parts of that province. And at the time, I didn't realize this, but Beijing asked the other 36 provinces, including Hong Kong, to invest in Sichuan to help the recovery. And I think the only reason I found this out was Hong Kong built the new Panda Center. Now, in Europe at the moment, we would argue that Greece is where Sichuan was after the earthquake, but no one can give money into Greece the way Beijing organized it with all the provinces in China. That's the mechanism that is missing. That is the mechanism that will take Europe from this alignment of countries that we have at the moment with a common currency towards being one country, effectively. So I would expect to see these type of policies begin to be talked about after the British referendum. And then once we have the German and French elections out the way next year, I would expect to see real political progress in that direction. So it's going to take a little longer. As ever, you know, in Europe things take time. But I think that is the general direction. But I think underlying it, whilst it looks uncertain from a international perspective, it is underlyingly positive direction of travel for Europe. So I think that's how we see this playing out in the short term. Obviously, I'm happy to answer other questions, but you are going to see headlines every day about what's going on in Europe. And I think there's only 36 days left to the referendum. I'm sure most of us will be quite grateful just to get it out of the way and get on with it. Now, in terms of looking at volatility, you clearly, as I've mentioned with the oil price, maybe you need to scenario what you would do if Britain leaves. Now, one assumption of a Brexit is that sterling would fall 15 to 20%, as it did when we left the ERM in 1992. Now, I would argue for many of your clients, although I know it's harder now in China, if you could buy London 20% cheaper, I think that's a bit of, it's like having the UK on sale. So I would buy London 20% cheaper. So I think there is an opportunity, if Britain leaves, to buy UK assets with a lower currency. And certainly for many of the UK companies who earn their money overseas, a lower currency would mean more profits. So they would instantly, on a sustained basis, become more profitable and more attractive. So that's one thing that I would look at. If you already own, or your clients already own property in London, then I would simply tell them that after the ERM, sterling fell 20%, and within 18 months, sterling was stronger than the day it left. So although there will be a 2-year negotiation period of the UK leaving Europe, within 2 years, I think it's fair to say, as the 5th largest economy in the world, that the UK would get on with it. It would make new trading agreements, new arrangements, and things would move on. And even if you think about the relatively negative campaign that's being put against the UK leaving, we think this is something that will bang the heads together, and therefore even if the UK is leaving, there will still be a constructive rapport between London and Brussels and Berlin. And this really simply shows that despite emerging market weakness, the Volkswagen scandal, the refugee crisis, and the terrorist attacks, Europe is doing pretty well, and people remain optimistic of what's going on in Europe. So we feel that Europe is quietly trundling along, doing quite well. Now, I know I would have shown you this chart before. This is the Case-Shiller 10-year rolling average. We use this to value equities around the world. So in brief, the way I would describe this is the US is the most expensive market in the world. And that valuation means that on average, it will generate a 1% to 2% return per annum for the next 10 years. And if your clients are looking for 5 or 6% returns, the more you have in the US, the harder or more risky you're going to have to take with other parts of the portfolio to generate the returns. Just to barbell it for you, Greece, we know it's a difficult market, but Greece is valued to generate 17% returns per annum. So when we look at this from a strategic perspective, we would argue that Europe and many Asian markets look attractive. So one should be looking there rather than looking at the more expensive markets. When one thinks about Asian markets and emerging markets, we think you need to differentiate, because many of the commodity emerging markets are going to struggle as China now rebalances. The fall in commodity prices, particularly industrial commodity prices, now looks permanent, in which case these economies need to restructure significantly. And therefore, we think we would compare an India or an Indonesia against something like a South Africa or a Brazil or a Turkey or a Russia, because they are too sensitive to the commodities. And this just shows it in aggregate with the US on 26 times. You can see that you're buying the world on 20, emerging markets on 15, and Europe on 15. So there's a lot of other value in equities around the world to be considered rather than just the US. And I think importantly, in a period of financial repression, what this chart tries to show is the power of dividend investing. Over the medium term, obviously, bull markets are founded on rising earnings and a rising revaluation of equity markets. Well, what we know for certain now is that equity markets have generally re-rated. So what we're looking for is either dividend income from the equity return or earnings growth from the equity return. Now, the market as a whole is struggling to deliver significant earnings growth. Therefore, we think you should look both in Europe and globally for companies that are still growing. There is growth in the world. It may be different because of the millennials and the demographic change and the aging, but there is growth out there. But you want to find those companies that have a strong business model that can reinvest at 10 or 12, 15% interest rates, return rates, and you leave that money compounding for as long as you can with your clients. The alternative is to look at this chart and say the most stable the most stable return within equities is the dividend yield. And therefore, many clients are looking for income. I can find many stocks around the world, but particularly in Europe, that are high yielding, the dividends are sustainable, and inside a low returning environment, in equities as well as in other asset classes, the dividend income is something your clients can live off and enjoy. And the nice thing about higher yielding equities is that they are lower volatility. Now, I think many of you would know that when the markets are going up, your clients are not worried about volatility. They like the rising tide of markets. When the markets are going down, they don't like that scenario particularly, but they would like a product that goes down less than the market goes down. Higher yielding stocks are lower beta, and therefore they protect against some of the negative volatility that clients are worried about in equity markets. But I think one other thing that I would highlight is the blue line in Europe at the top, near 4%, shows you the stability of the dividend yield of the market in Europe. The light blue and the red line show how much cash and corporate bonds have been affected by the quantitative easing of the ECB. So what is different in Europe at the moment from what has happened in the US is the quantitative easing hasn't seen the money go from cash and bonds into equities. If you go back and look at the charts, the quantitative easing in the US and the S&P correlated very strongly until the Federal Reserve stopped doing QE. So what is interesting in Europe, and is a conundrum even for us at Allianz Global Investors, is the Europeans have not taken their money from bonds and put them into equities, even though they yield higher. Just think about it, an example from Switzerland. The current negative interest rate on cash in Switzerland is now 80 basis points. So it's nearly 1% you lose every year if you have more than 1 million Swiss francs in your bank account. We think over time this will also happen in Europe as people become frustrated with the fact that their cash and their bonds generate no income at all. And so just to finish, I think even here in China, although growth rates are going to be higher, global growth rates are going to be lower. Inflation remains low, and therefore many of your clients are going to struggle to earn the types of return that they have been used to. We also think that because markets are now more volatile, your clients need to find alpha as an important part of the total return rather than just picking something because they think there's going to be a beta return in it. We think that's going to be very hard to find. But we do think that volatility is here to stay. And I think what you and your clients have to work out is a way of navigating this volatility. When things are going up, you might actually think about selling them. And when things are going down, you might actually think about buying them. Because what I would say as a portfolio manager is you have to think about positioning. Things might be going up because market participants are buying it rather than because there's any economic reason. Think about what's happened in China in the last 3 weeks in iron ore. There wasn't obviously a demand for iron ore, but the market decided to have a run at the iron ore futures contract. Now, If there's no fundamental reason why iron ore is going up, then eventually iron ore, guess what, will come back down again. So the key inside the way I now look at the markets is not necessarily to not look at the economy, but I also look at where people are positioned. If everyone is short the dollar, you don't need people to get bullish of the US, you just need people to decide to sell the dollar, to buy it back. So positioning in markets is now very, very important because a lot of markets are quite illiquid, and therefore the volatility in the markets will not necessarily resonate with the volatility and the politics in the economy. So positioning in the markets is now very important. It's something to follow. And also, and many of you may be aware of this, there's a lot of now short-term hedge fund type money that is run on basically computerized chart systems. And therefore, as an investor, you need to know where the key stops are in the marketplace. Because when they get breached, they will trigger different events. All you can do with your clients is help them navigate this volatility by understanding that you have economic volatility, you have political volatility, and there are market players out there who will want to create volatility because they benefit from it inside their investment strategies. All this makes our job of helping you and our clients find the way from A to B just that little bit harder. And of course, it's all happening so much faster.